Okay, let's talk about something that trips up so many businesses in Japan. You take a client out for a nice dinner, you think you're doing everything right, and then bam, suddenly you're facing thousands in unexpected taxes. How? Welcome to the world of kosai-hi, Japan's corporate entertainment expenses. Honestly, it's a minefield. But don't worry, today we're going to give you the map to walk right through it safely. All right, so here's our game plan for today. First up, we'll look at the minefield itself, why tax auditors are so obsessed with this stuff. Then we'll get into the nitty-gritty. What exactly is an entertainment expense? After that, we'll break down the rules by company size, because they're not the same for everyone. We'll also highlight the most common traps that catch people out. And finally, we'll wrap up with a super simple 5-point checklist to keep you safe. All right, let's get into it. Why is this one area, entertainment expenses, under such a massive microscope? So really, why do tax auditors get so worked up about these expenses? I mean, what is it about a simple dinner receipt that just screams, audit me? It's a serious question, and honestly, it's what keeps a lot of finance folks in Japan awake at night. It really all comes down to one thing, that blurry line between a legit business expense and, well, a personal party on the company's dime. Think about it. Is that fancy dinner really for sealing a deal, or is it just a nice night out for an executive? That's the gray area tax auditors live to explore. Their whole job is to make sure company funds are actually for the company. Okay, so to get through this safely, you have to know what you're looking for, right? You need to know what a mine actually is. So let's define our terms. What exactly is kosai-hi? And maybe just as important, what isn't it? So the official definition is pretty broad, but you can just think of kosai-hi as the money you spend to, grease the wheels of business. We're talking dinners, maybe a round of golf, those seasonal gifts, anything and everything you do to build and maintain good relationships with clients or suppliers. The key word here is purpose. It's all about relationship building, not a direct business meeting. Now listen up, because this is a big one, and it's recent. The government just made a huge change. They doubled the per-person limit for food and drinks that can be kept out of these tricky kosai-hi rules. It went from 5,000 yen up to 10,000 yen. And trust me, that is a total game changer. It means way more of your everyday business meals can just be classified as simple meeting expenses, which is so much easier. But, and there was going to be a but, right? There's a catch, a big one. You can't just have a receipt for under 10,000 yen and be done. No way. To get that exclusion, you have to have all 5 of these things documented. The date, who was there, how many people, where you ate, and why. If you miss even one of these details, then poof, that expense gets thrown right back into the kosai-hi pile, and you're back to square one. You see, it all comes back to that word again, purpose. This is where tons of businesses mess up. They get these 3 categories all jumbled. You've got kosai-hi for schmoozing with clients. You've got meeting expenses for, actual meetings. And then you have welfare expenses for your own team. Knowing which bucket to put your spending in, that is your absolute first line of defense. Okay, so just when you thought you had a handle on it, it gets a little more complicated because the rules are different depending on how big your company is. Yep, your tax deduction for these expenses is tied directly to your company's capital. So let's just break this down. If you're a small to medium business, we're talking capital of 100 million yen or less, you actually get a choice, which is great. You can either deduct 50% of what you spend on food and drinks, or you can deduct a flat 8 million yen of your total entertainment spending for the year. You pick whichever one saves you more money. Now, once you get bigger, the rules get tighter. Over 100 million in capital, you can only deduct that 50% for food and drinks. And if you're one of the giants, over 10 billion yen in capital, tough luck. You get 0, nothing. Not a single yen is deductible. All right, time to talk about the actual mines. We know the rules, we know what we're looking for, so what are the common traps that people fall into? Let's look at the things that will absolutely blow up your expense report during an audit. First up, the classic, the private dinner disguise. This is when someone tries to claim a dinner with their spouse or a friend as a business meeting. Just don't. Seriously, an auditor will sniff this out in a second, and once they do, your credibility is shot for everything else. Oh, and then there's this one, for the people who think they can outsmart the system, the split receipt gambit. You have a big dinner, and you ask the restaurant to print you a few smaller receipts so you can stay under that 10,000 yen limit. Look, auditors are not dumb. They've seen this move a million times. This isn't just a simple mistake. They see it as fraud, and they will come down on you hard. Trap number 3 is maybe the easiest one to fall into, and it's just from being lazy. The vague record problem. You have a totally legit business dinner. You did everything right. But you just toss the receipt on your accountant's desk with nothing written on it. To an auditor, a receipt with no notes, it's just a piece of paper. It could be anything. They need to know who was there and why. Without that, they're just going to deny it.
And finally, trap number 4, going way over the top. Yes, there is such a thing as an excessive expense. Even if everyone at the dinner is a client, you still have to be reasonable. If you're trying to sell a pretty basic product, an auditor is going to raise an eyebrow at a 5-star multi-course dinner with vintage wine. The spending has to make sense for the business you're trying to win.
So what happens when you step on one of these mines? Well, it's not pretty. It's a domino effect. First, the expense gets denied. That means your taxable profit goes up, so now you owe back taxes. Then they slap on penalties for being wrong. But the worst part? It's like you've just invited the auditor to stay for a while and take a much closer look at all of your books. It's a headache you really, really don't want. Okay, that was the scary part. So how do we avoid all that pain? How do you navigate this whole thing with confidence? It really comes down to having a good system in place. So let's go through a simple 5-point safety checklist that'll keep you out of trouble.
All right, this is it. This is your cheat sheet for staying safe. Number 1, document everything. I'm talking the who, what, when, where, and why on the back of every receipt. 2, classify it correctly right away. Is it settai-hi? Is it a meeting? Decide then and there. 3, make sure your whole team understands that new 10,000 yen rule and what they need to write down. 4, keep it reasonable. Don't go crazy with the spending. And 5, have some kind of internal approval process, so someone's checking this stuff before it even gets to accounting. You do these 5 things, and you're building a pretty solid wall around your company.
So I'll just leave you with this one final thought to chew on. Right now, is your company's expense process a fortress? Or is it more like a trail of breadcrumbs leading a tax auditor right to your front door? It's worth taking a serious look, because with Kosai Foki in Japan, a good defense isn't just the best offense, it's everything.